morning. Hi, it's Mary Ellen McGonagle, and you're watching the MEM Edge Show. And this is the show where we put you in front of where the action is in the markets. And it certainly has been quite active here recently. Just taking a quick look at the VIX, and you'll see the volatility is alive and well. Unfortunately, a lot of the action is to the downside, but there are some bright spots. We're going to go ahead and cover that as well as quite a bit else. Let's take a look at today's agenda. First off, we are going to take a look at the current markets. We always like to see where we are in the broader markets before you do any kind of action, buying or selling. Of course, you do want to have that backdrop where we are. What are the markets poised to do here? And then also we're going to take a look at what I call the anatomy of a broken stock. And the reason we're going to do this is I want to show you what a stock looks like on the way down. A lot of people may have stayed with their stocks given the current market environment with an eye toward a recovery, but it's important that you know that not all stocks are going to recover when the markets do turn healthy again. So we're going to take a look at a couple of stocks that really are not looking healthy, and again, to help pinpoint for you when it may be time to exit that stock. And then also taking a look at some short-term plays. I talked about volatility in the broader markets, and there are in fact some ways that you can play that volatility. This is going to be for the more active trader, those that are not afraid to get in and out of stocks in a fast fashion. So we'll go ahead and review that. Also, how you can prepare a watch list so that you are prepared when the markets do recover. And we're going to review ways that you can put aside this list and have it on hand so that you can benefit when the markets do return to a new uptrend. And then lastly, looking for stocks that are in defensive areas of the broader markets. I talked about pockets of the markets that are withstanding the downtrend that's occurring around them. So there are ways that you can be long this market, and ideally it will be in those areas of the market that are viewed as defensive. So let's go ahead and get started. We're taking a look here at a daily chart of the S&P 500 large cap index. This is as of the close on Friday. And you can see last week, we sure did get quite a bit in the way of volatility. Now, what I've done here with these daily price chart is overlaid simple moving averages. And the first line here is green. That's your 21-day simple moving average, followed by the red line. That's your 50-day simple moving average. And the blue is your 200-day simple moving average. Quite simply, these are smoothed out price lines of the prior, in this case, 21 days, and so on. So these are very widely watched simple moving averages by traders, investors in the broader markets, generally used to define support and then potentially resistance. So what I want to point out here is with this 21-day, you can see how it was indeed acting as support for this broader index on the way up. You can see the index very nicely was pulling back, but then we did have this first break here. This is taking us to the beginning of October, about 3 weeks ago, and you can see this break here did occur on big volume. Certainly as we moved down under more distribution, we did get that volume, and that's something you want to key in on. That volume is telling you institutions are headed for the exit door, and it will take time for these institutions to unwind any positions that they may want to let go of. So what I also did want to point out here is the blue line is your 200-day simple moving average. And this, again, is very widely watched. A break below that 200-day is viewed as quite negative. So last week, we essentially danced around this 200-day moving average. You can see we undercut it, traded up above it, and so forth. Quite a bit in the way of volatility. But we did close above that upward trending 200-day, generally viewed as constructive. But let's take a look at some of the other metrics here on this daily price chart. Down below, I have a momentum indicator. It's known as the stochastics. And over here in July, I wanted to point out to you, capturing the look of a market that pulled back but then turned positive. You want this stochastic to be heading north, trading above ideally this dash net neutral. So we can go ahead and take a look here, and in coinciding with that positive stochastic turnover, we also had the price breaking back above this 50 and then 21-day simple moving average, and indeed your uptrend was resumed. Now let's go ahead and take a look at where we are now. Of course, we're quite a bit lower as far as the price action, now down around this 200-day simple moving average. Your stochastics, we had a tough week last week, so they are, as of last Friday, trading the wrong direction, if you will. They're trending a little bit down here. But again, ideally, at some point in time, we do want to see that crossover above this net neutral, and coinciding with a break back above these shorter term simple moving averages. Now, in this case, we have the shorter term moving averages beginning to trend downward. We can go back to this corrective phase here in the February-March period, and you can see once these shorter term moving averages go into a confirmed downtrend, it's really quite difficult for the markets to then just reverse. So ideally, we don't want too much more downside to take place here before it turns, because then it gets really quite heavy. So that's taking a look at the S&P. Let's go ahead and move on here. Take a look at the NASDAQ. Again, this is as of the close last Friday. Very similar action, except the NASDAQ has broken that 200-day simple moving average. I talked about that being significant. It is distressing, if you will, for the broader markets once we do break. And then we can see also the stochastics are trending a bit downward. So in essence, the NASDAQ had led the markets going into certainly the latter part of September, but we can see that the NASDAQ has broken down, and this is called loss of leadership, and it's not what you want to see. Certainly it's not healthy, but again, this is where we are currently. All signals are pointing toward near-term continued downside in the broader markets. Now, let's go ahead over and take a look at areas outside of those broader indices. Drill down, if you will. This is the candle glance view. This is available on the interface, initial interface page with stockcharts.com. You can populate this with the tickers of your choice. And for today, I've chosen not only those broader indices, but I've also populated the candle glance with some individual ETFs that represent various sectors. So we have XLI, the industrials, XLY, the consumer cyclicals, the financials, energy, and so forth. And so what you can do from there is go ahead and choose your chart duration. 2 months is fine, perfectly great considering where we are in the broader markets. We want to capture recent activity. From there, you can overlay an indicator. And for my work, I like to use that RSI. It's a relative strength momentum indicator. And then you can go ahead and sort that in descending order. And what that it will do is quite quickly provide you with a snapshot of where we are as far as strength, if there is any, in the broader markets. So we can see initially the first area of what you might say is strength, but certainly it would be volatility. We've seen a big pickup here in volatility. For those of you that are familiar with the VIX, as it's known, it is better known as the fear index, and generally anywhere in the 18 to 20 range, if we start to creep into that area, that is not positive for the markets. We are right now at 20.5. So I would urge you to stay on top of that VIX if you are not already, because it is going to give you an indication of the anxiety, the fear that's out there in the broader markets, which in turn is a negative. So from there, we can see that healthcare, now healthcare is suffering a bit today, but certainly on a 2-month relative basis, it is in the forefront. This is something for those of you that have watched this show on a weekly basis. You'll know that I've been talking about healthcare for quite some time, in the sense that it is viewed as a defensive area of the broader markets. Healthcare is a lot of the products, services, they're going to be in demand regardless of tariffs, tax increases, and so forth. So this is viewed as a defensive area. It is, again, also in the forefront. And then we can see unusually technology, which has not fared so well, but more recently we've seen a little bit in the way of stabilization. So tech is shown next, and so forth down the line. Now let's go ahead down here on the very lower right-hand quartile. This is your weakest area, and this is the Russell 2000 index. These are your small cap stocks, and small cap stocks did falter prior to the broader markets. We're taking a look at a daily chart here. I'm taking you back to September, and of course hindsight is 2020, but it is worth noting that historically small cap stocks do lead the markets lower. This is, again, based on historical precedent. Oftentimes, it can lead the markets after we come out of a corrective phase. And I would take you back to the correction that occurred in the broader markets at the beginning of this year. We can see that small caps did, in fact, lead us out. We can also look historically after the 08-09 bear market. It was certainly all small caps that were the first to bounce. So you will want to keep an eye on this Russell 2000 as one of many potential signals that the downtrend has reversed. So let's go ahead, and we've taken a look at the broader markets where the relative strength is. Certainly there's not a lot of strength, pure strength, but we did take a look at that relative strength. Let's go ahead back, and I mentioned to you that we can take a look at some stocks that have broken down, and they are a little bit further along in their downtrend. Again, this is designed to be educational as far as those that may have held on to stocks. You're thinking that the markets, that individual stock may come back. What we're looking at here is a company, East West Bancorp. EWBC is the ticker symbol. And for many of you that follow the market super closely, you'll know that financials, and in particular bank stocks, have really struggled. This is taking us back to the June period, and the, again, anatomy of a broken stock. Let's take a look at some of your initial signals that we've seen already in stocks where they break down. In this case, I have a 10-day simple moving average. The red is your 50, the blue is 200. So your first sign of possible downtrend is the stock breaks below that shorter term simple moving average. As we progress, it then breaks down below your 50-day simple moving average. Now, I do produce a biweekly newsletter with alerts throughout the week. And for those clients that subscribe to my newsletter, we were getting out of stocks as they broke that 50-day. That was something that I was advising, because oftentimes those breaks, particularly if they occur on any kind of volume, they are foretelling as far as potential more downside. So in fact, with this stock, we can see what we also want to pay attention to is that relative strength indicator, that RSI. I have overlaid it up here. The RSI broke below this net neutral. So we have that trending negatively. And then below, I have what's called the MACD. That's a moving average, convergence, divergence. This is another momentum indicator. And what you're looking for here is a crossover, that black line crossing down through the red. So that's very negative. So we can see as this stock progresses, what you want to key in on is the fact, we talked about this with the broader indexes, once these key moving averages begin to trend downward, then we have a very heavy pattern. Any rally attempts will be met with resistance. And throughout this continued downtrending period, your RSI remained negative below this net neutral. And then your MACD also went below its net neutral and zero line and was very, very negative. So we can see this continued decline, deterioration. The stock does eventually break below that longer term 200-day simple moving average. And sure enough, more deterioration here on super big volume. So just keeping you alert to what to look out for with your individual stocks. Here's a small cap software stock. This ticker is AppFolio. AppFolio. This was one that we had on the suggested holdings list for my newsletter. So we were able to take advantage of this very nice uptrend from April into September. But once the stock broke down here through its 50-day, we exited the stock. And you can see how it did have further deterioration, but all while using these overlays, looking for breaks below key simple moving averages and marrying that with your negative black line through the red MACD and your negative RSI, which would keep you out of this further additional deterioration. And we can see it's just now poised at its 200-day simple moving average. And then also you can take a look. We already did take a look at the Russell 2000. The reason I'm pointing that out again is because APPF is a small cap stock. So you want to also take a look at what area of the market your stock is in. Is it in an area that is under severe distribution as well? That's going to be yet another signal for you to key in on, again, as far as whether you should stick with your stock or is it time to exit and move on. Now, let us take a look. I talked about, this is also one other thing I did want to point out to you, that APPF that was breaking down, not only was it a small cap stock, it also was in the cloud computing space. And this is SKYY. It's the daily chart. This is a cloud computing ETF. So again, in addition to looking at what area of the market your stock is a part of, you also want to look at the sector or grouping. And this is, again, cloud computing. This is an area that has broken down again through this 50-day simple moving average, and your other indicators also turn negative. And this would be another signal for you that your stock may indeed have further downside ahead. And another stock that really 2 weeks ago, it looked poised to, it did in fact hit a near-term high. This is Caterpillar, CAT, and we can see really just how quickly stocks in the market can turn, because this was an area in the beginning of October, again, that really looked poised to continue its uptrend. So again, taking a look at those signals, if you do have a stock that is bucking the broader market's downtrend, here are the signals that potential uptrend has reversed, again, breaking down through that 10-day simple moving average. And then in this case, it then broke the 200 followed by the 50, all while your RSI began to trend negatively. You want to pay attention to that volume. If it's breaking down on volume, that is going to be another signal that more downside may in fact be ahead for that particular stock. And really, that's it for those stocks as far as helping you identify what to key in on for those potential uptrend reversals. I talked about the ability to take a look. Again, given the volatility in the broader markets, there are potential short-term plays. And this, of course, is going to be for the very active trader that stays on top of the market, on top of stocks. What we are looking at here is an intraday chart of PayPal. PYPL is the ticker symbol. This company came out with very positive earnings last week. So I have a 1-hour price chart. Each one of these bars is 1 hour of activity. We're still using the RSI and that MACD. Your simple moving averages are 8 and 13. So what I wanted to point out to you, and you'll see this even though the broader markets are in a downtrend, periodically you'll see companies that will gap up and respond positively to a given earnings report. So we have this initial gap up, and then if you were of a mind, you thought that perhaps the stock may continue its uptrend, we can see that the RSI certainly turned quite positive. Your MACD is now up above this net neutral, this 0, and it's holding support above an upward trending simple moving average. Now, I would like to take a look at it. I'm today is not the best of days, but of course, if you are playing these shorter term possible trades, you will want to make sure that you have the backdrop of the broader markets behind you. So you want to make sure that the broader markets are also rallying on that given day, that you are looking for these shorter term plays. Let's take a look at another possible example. This is Natural Grocers, NGBC. It's a very small cap retail supermarket defensive stock that I talked about on Friday. I was part of Market Watchers Live, What's Hot, What's Not. And this is one of the stocks that I reviewed as being hot in the sense that the stock was in an uptrend. This was an uptrend that began, again, we're looking at a 60-minute intraday chart. And the stock started to pick up here on the 16th. This is taking us to last week. We can see that RSI trended positively, as did your MACD. And you can see that it did enter into this uptrend. I guess it did open today up a little bit. So these stocks that are defensive in nature may be your better bet, if you will, because not only are they food stocks, food retailers are viewed as defensive, you will have that as your safety net, so to speak, in these markets. And then one last stock, this is a really small one, FRED is the ticker symbol. And I wanted to also point out, this is another stock that last week started to pick up. And the way you could get these potential candidates, stocks for shorter term plays that are bucking the broader markets, take a look at the new highs list, and we'll go ahead and look. I can't imagine there's a lot in the way of hitting new highs, but that would be one area that you can look, or up on volume. We can see that this is a small stock. It doesn't get a lot of volume, but we can see that it did in fact pick up here on the volume. So those are two screens, again, with the idea that the backdrop of the broader markets is behind you, and you can pick up the potential upswing in some of these stocks as they potentially outperform the broader markets. So I do have a number of other things I wanted to cover, but let's take a look at preparing a watch list during market pullbacks. And certainly we are in something more serious than a pullback, but the concept is still the same. You are going to want to put aside a list of stocks that are, again, they're withstanding the downward pressure. They don't have to be going up. They could very well just be trending sideways, but in essence, these are stocks that are withstanding that downside pressure. On a relative basis, they are outperforming. We're going to take a look at some examples here, but you also want to make sure that that stock does have sound and strong fundamentals. They are growing their earnings, their sales, profit margins, and so forth, but also they're in a growing industry, an industry that has demand, so that when those market pressures are lifted, you are then going to be in a stock that is poised to continue to outpace the broader markets and move to the upside, certainly. So let's take a look. Here is a good example of a stock that very well could be on your watch list. This is Verizon, ticker symbol VZ. We're looking at a daily price chart, and take a look at this recent action. You can see that the markets are poised, Verizon is poised to break out of a base, and clearly this stock is bucking the downtrend that's happening all around it. We can take a look at that RSI in an uptrend, as well as this MACD. And so again, this is an area of the market that is not viewed as defensive. We talked about the need for the stock to be in an area of what's called growth. And indeed, Verizon is in a growth area. They've just rolled out what's called their 5G broadband. And the company is, this 5G is expected to really transform the way super fast broadband service is provided. It's really being embraced by certainly analysts on Wall Street, but also corporations, those that want to have super fast broadband service. As an aside, Verizon does also offer a 4.4% yield, but it is in an area that is very hot right now. The Verizon, there are a number of other peers within this media communication services area that are really holding up quite well and bucking that broader market. Here's another example. This is Discovery, DISCA. And again, take a look at this action. It is really ignoring what's going on around it. That RSI is trending positively, and then your MACD is in positive territory. And this is a company where analysts are anticipating 10% earnings growth this year, but next year they've upped their analysis, they've upped their estimates, and analysts are looking for 57% in the way of earnings growth for this company. And Discovery Channel did just sign a deal with Hulu, and they have a number of well-known, very popular brands beneath them, HGTV and so forth, to name a few. So again, this is what you do want to be on the lookout for, is those stocks that are withstanding the broader market pressures. And what we can do from here is take a look at yet another example. This is Walt Disney, DIS. We're looking at a daily price chart. Walt Disney has a lot in the way of what's called intellectual property. They own Star Wars, Marvel, and so forth. So this intellectual property is viewed as super, super valuable. But also Disney announced a new deal that they are actually going to be and have been providing a streaming service that is being widely embraced. It provides a continued revenue source. So you can see that this stock actually hit a new high last week, and that's really, really powerful given what we've seen that's occurring out there in the broader markets. We can see that this RSI is trending positively. Your MACD has turned positive, and this breakout last week occurred on very, very big volumes. So that's also quite constructive. The company has a 1.4% yield. And let's see if we can take a look. Well, we can certainly go out of here, and I can provide you with a couple of other examples that you can take a look at. Again, we'll do one more example of a stock that is withstanding the broader market's pressures, with an eye toward putting together this watch list for those potential winners when the market pressures lift. And this is McDonald's, MCD. And I'm going to pull up a weekly price chart here. And we can see yet again, here's another stock. It's not as dynamic as the others, but certainly withstanding the broader market pressures. And we can see that the RSI is trending positively. Your MACD just poked up into positive territory. I believe this company is due to report earnings this week, but with an eye toward longer term to have a stock. This also offers a 2.8% yield as a side note. So there are some examples. And then let's take one. I have very limited time left, but I did want to point out to you, we talked about the concept of looking at defensive areas of the market. So with stock charts, we can just go ahead and drill right in. We're looking at the S&P sectors. I like to look at this from a 1 week point of view, and we can see this is going to automatically sort this by percent change, and we can see consumer staples are up here at the forefront. So the markets have indeed turned defensive. So from there, we can go ahead and let's take a look at how you might uncover possible candidates in the defensive area. So non-durable household goods are up very strongly. Procter & Gamble came out with some good numbers last week, so that we can then drill down from there. Go ahead and hit that scooter. This is your technical indicator, and you can look at the thumbnail snapshot of the underlying stocks, and these are all looking quite attractive. So I will need to leave it at that. For those of you that want to find out more about my work, go ahead and take a look. This is my website, MEM Investment Research. I offer a lot in the way of courses. I talked about my newsletter, and would love to hear from you. You can contact